everyone. Hey, welcome to Finance Friday. This is the show where we transform your money by giving you the information you need to grow and protect your wealth. I am Amy Novakovich. This is Ryan.
Hey everyone.
Follow us on Twitter at Nova Wealth Management. Management's abbreviated MGMT. Check out our YouTube channel. Our website has all our social media, novawealthmanagement.com. You can contact us from there. Share this out because this is a topic we've been getting a lot of question on. When people need cash, they want to know where can I get money from? I want to get added money. I don't know what else to do. I'm out of PPP money. Oh, there goes our light.
We just lost our light.
It's okay.
Production in here right now is
tough,
not good.
I know. Where's our production
We need to fire
team?
somebody.
I know. So when people are tight on money, they're like, what are my other choices? And there is another choice, however, not always something we recommend. So we
Right.
wanted to go over what margin is, and actually we can even talk about 401k loans because it's similar, not the same mechanics, but it's the same idea of borrowing from your own money to then use that money,
Yeah.
right?
Yeah.
So do we want to start by just explaining in simple terms what margin is, and then we'll go over the pros and cons, and then who it is most appropriate for?
Sure.
Go ahead.
Yeah. So margin is basically using your current investment account as collateral for a loan, is ultimately what it is. And you can take up to half of your account balance.
Actually, this year because of
No, this
the
for
CARES Act.
did they include for
to
margin
100%.
accounts? Okay.
Oh, no, not margin.
Yeah, we're talking about
Sorry.
margin accounts. So
Sorry.
margin accounts. I'm about to
Scratch
throw a loop in there.
I'm not-
Scratch
I'm
that
just
last 15
trying to make
second
sure he's
interaction
paying attention
here.
since nobody else is with it
Yeah.
here.
So you can take up to 50%
Okay.
of your account balance. And another thing to note about it is that it has to be above a percentage. Usually for equities, it's 30%. Or else you'll have
Equities is stocks.
yeah.
if I'm
So
not sure.
or else you'll be called and having a margin call. So that means that if, for example, your loan is more than 30 or more than 70% of what your account balance is, then you're going to actually have to put more cash in, and that's one of the risks. So
That is a huge risk.
and so that's, but basically what a margin is, and I guess I didn't keep it super basic there,
You
is
did.
basically just
Not
taking
so
a
much.
loan with the collateral, it actually having collateral, and that collateral is your investment account.
Now, there's a second option with margin that we weren't really going to talk about today because this is about how do I get like extra cash, extra liquidity. But on margin, you actually can use that loan, like you're borrowing against yourself, to actually purchase more investments. So, for instance, let's say you have a $100,000 account. It turns that $100,000 account into a $150,000 buying power, buying opportunity. Now, again, these are not recommendations. We're just doing this to inform you, just being educational, because it's actually not something we've really recommended.
No,
We have
not usually.
two different firms, let's call it, we call them custodians, that we place money at. And one has an interest rate of like 2%, and the other has an interest rate of like 9%. So you have to check out the interest rates. Because it doesn't make a lot of sense to do that. If you're going to have to pay 9% on your money, then I have to make over 9%. So
Yeah.
it's super risky, guys. But it is, like Ryan said, it is as simple as you're borrowing against your own money. Now, this isn't an IRA. You cannot do margin on an individual retirement account, which is an IRA, a retirement account. So if you had rolled over an old 401k and put it into an investment account, if it's titled in the title IRA, individual retirement account, you cannot put margin on it. Why? Because the IRS says this was deemed for retirement. It's meant for retirement. You already have tax benefits. You can't borrow from it. So it has to be money that was not retirement money, just regular every day after you get your paycheck in the bank and you put in money into an investment account to invest. So some of the pros, so let's break this down. Again, margin is borrowing against your investments. Very,
Simply.
I would say that's simply.
Yes, yeah. Not much of a simply guy.
No. So the pros are you definitely can get some cash out if you need it, if you have an investment account and you don't want to cash in your investments. Because some people might be sitting there thinking, if I have 100 grand in an investment account, why don't I just use that? Well, the market's down. Maybe you want to sell
Yeah.
your stocks right now. You feel like that's going to cost you money in the long run.
And that's why we're talking about it in this time.
Well, that's
because
why we
this
keep
is
getting
when-
questions
Yeah,
on
so
it.
people want to know, well, how can I get cash? And so if you can find a lower interest rate, then
Which
it
we
might
use
make
Interactive
sense.
Brokers, so
Yep.
you can check out Interactive Brokers if you're trying to consider this for
Mm-hmm.
yourself. Again, not a recommendation. If you aren't sure if this is appropriate for you, call us and we can help you determine if it's appropriate for you because it is super risky.
Yeah.
But it is something that is available if you don't want to go cashing in your stocks.
And better than putting things on a credit card potentially if you're going to be paying
Right.
high interest. So
Right, yeah, you could
Um,
pay 25% on a credit card
Yeah.
versus, 9, actually IB, Interactive Brokers, what I say, 2%. It's like
yeah.
2 or 3,
Yeah.
something like
So
that.
usually much lower than that, of a credit card and things like that. And so it could be a good use of if you're just wanting to take, I would say, short-term cash.
I didn't bring my phone in.
then-
Did you share it out?
No, I didn't yet. I will.
Why don't you?
I do. I just didn't.
And
We
I
were
never,
talking.
I never forget my phone. I always bring it
You
in.
can share it after. It's fine. People will still watch it later.
I know, but
when
then they
most
could have
people watch it
joined
anyway.
live.
Well,
It's okay. Anyway,
we're
so
arguing.
some of the pros are, okay, again, you can get more money out of your money to invest. You can get some cash. The risks are, though, if the market were to go down further, you might actually have to come up with money, or then you're going to have to liquidate your securities anyways.
Yeah.
Some of the other cons are you have to pay interest. It's not for free. Some of the other cons are, well, you got yourself into further debt essentially
Yeah.
against yourself, though.
Yeah.
It's better than a credit card, but
Potentially against yourself unless it gets really bad. I mean, the idea is that basically it doubles the loss. If you everyone will say, oh, margin is a great idea when the markets are going up, right? And they actually say that one of the biggest reasons, or not one of the biggest, but a factor in the Great Depression was because there wasn't a huge regulation on margin. So all these people had margin loans, and when the market goes down, it hits it even harder, and so you see this
and they
steeper,
can't
steeper
come up with the
decline.
money, and then they have to sell in the account to
Yeah.
meet the margin
Yeah.
call, and it gets kind of messy.
Yeah.
So it's certainly risky. So you absolutely have to know the pros and the cons. So who is this for? This is for somebody that really understands investments. Like you really should not do this if you don't know what's going on already. You don't know how to read your statements, because if you don't know how to read your statements now, wait till you get margin on there. It makes it really confusing. So you certainly need to know what's going on, have a very good level of knowledge on investing and investments. You really have to have a good grasp of, have I exhausted all my other lending capabilities? Is this my last resort type thing? Or again, if you're using margin to increase your buying power and buy more investments, now you're getting aggressive. So you have to be able to stomach the ups and downs of the market. If you've never been through a downturn in the market, you don't know if you can handle it. So I would highly suggest this is more experienced person, somebody that really knows what is going on, because I just don't think the novice investor that says,
Yeah.
I really don't know what equities is, like you said,
Right.
the word equities, and if you don't know
Yeah,
what
if you
that
didn't know
word
that, then
is,
margin's probably
then you
not
probably
the
shouldn't
best
use
thing for you.
margin.
Yeah.
But we have been getting a lot of questions around this just because people do hear these buzzwords, or they see an ad, or they read an article saying, oh, you can just borrow against your investments.
Yeah.
So let's talk quick about borrowing against your 401k. It's not margin. You're not.
It's
It is similar to
it's
margin.
similar, but
just
way
different words. What do you mean similar but way different?
I think it's way different because you're with a margin. Ultimately, with a margin account, you can take as long as you want to repay it, and then you can have 401k, but you have minimum payments due. Whereas with a margin, as long as you pay the interest due, you can keep that loan out as long as you want. Assuming that you don't get a margin call like we talked about where it
Right.
dips in the market. And so I think that it's the same idea where you're borrowing and using collateral, like your collateral is your investment. So that's where it's similar. But the amounts you can take out against it percentage-wise is different. Now that with a 401k, it's what you can take up to a 100%
right,
loan.
which is more than margin.
And I think that the idea that you have to make payments towards a loan on your 401k rather than with a margin account, you want to make payment, like you don't want
You
to
have to
keep
make
that
payments
outstanding.
through payroll. Like it has to be
Yeah,
deducted
it
through
has
your
to
paycheck.
be. But with a margin account, you
Yeah.
don't. You have to maintain. You can even
Right.
get a interest balance. You don't even have to pay the interest if you really don't want to.
Right.
As long as you're not hitting over that threshold that's going to have a margin call. So that's where they're similar, but I think pretty different in those ways.
That's true. And actually, in the 401k, most of the time, it depends on the platform, but most of the time the money is not even staying invested. It's an actual like withdrawal from the account. It's not even like, It's not like a loan, but the money is still invested. Whereas in margin, if you own 10 stocks, those 10 stocks stay put, and you can borrow the money. It's just like you said, like collateral, like a house. You know, you don't have to give it up. You can still live in the house while having a loan on it. Same thing, you can keep the investments. But on a 401k, a lot of platforms actually have to sell off investments for you to take that money out. So it's simply just a withdrawal without taxes. So they call it a loan. So it's just semantics, but it's two different kinds of loans.
Yeah.
But there are some platforms, I think I had one with Chase once, that did allow the money to stay invested because it was structured in a different way. So it always pays to ask, it always pays to call your 401k company and just see what your options are. But you can take a loan against 401ks up to 100% for the year 2020 because of the coronavirus crisis.
Yeah, and that's a big thing to note too, that if they're separating out the funds when you take the loan, then you're basically compounding the impact it's having on your retirement, because you're not getting any growth. You're not getting that. The point of the retirement account, or one of the main points of the retirement account, is that you're getting this compounding growth. Yeah, they're not getting taxed on any of these monies while it's in that account. And so if you're not getting that growth and you're kind of putting it on the sidelines, you're missing out on that opportunity. And if you do it, with early enough, then it could have a pretty big impact on your retirement nest egg. So
it might not be a super smart decision.
Yeah.
So you definitely
talk
can't
to
take
somebody.
this lightly.
I mean, talk to somebody. We're happy to help you, but don't make these types of decisions. If you're looking and you need more cash, or you need, there's a lot of avenues and there's a lot of different ways that you can be strategic. So talk to somebody. If it's not us, talk to somebody about it. But again, we're happy to help in that for sure.
So I hope this helped, guys. We kind of a quick video today, 12 minutes. Is pretty
Yeah, it's
quick
probably
for
the
us.
shortest we've ever done.
But yes, you can borrow against your own investments, whether it's a 401k or whether it is a margin loan, but definitely not something that we just recommend. It is something that you really need to have a strategy behind it and talk to somebody so you're fully educated on what's going on and when you would have to pay it back and when you would have to come up with the cash, because you don't want to get yourself into a really bad situation.
Definitely.
All right, guys. Have an awesome long Memorial Day weekend. And if you have any topics that you want us to cover, feel free to go to our website, contact us on the website, novawealthmanagement.com. Reach out to us, message us. We're happy to we're open to topics.
Absolutely.
All right, guys.
Have a
Thanks
great
so
weekend.
much. Have a great weekend.